Hey everyone, this is Beinsuretalks, Insurance and Insurtech Insights. Today we'll be talking about a hidden back office crisis that is just, well, it's completely squeezing the insurance industry today.
Yeah, and we're going to look at why the race for automation is it's really no longer optional for these firms.
Right. And we are skipping the small talk today because the mission of this deep dive is incredibly urgent. We are unpacking the escalating settlement squeeze. We're going to analyze the staggering financial drain of manual errors. And most importantly, provide a clear, source-backed roadmap for operations leaders trying to transition from fragmented spreadsheets to fully integrated AI.
Exactly, because right now the system is fundamentally breaking under its own weight.
It really is. So to you listening, whether you are an industry veteran running a massive operations team, or, you're just trying to understand how massive financial systems scale or fail to scale, this deep dive is going to reveal why back office speed is the new ultimate competitive advantage.
It's a huge shift in how we think about the industry.
Yeah. So let's jump right in. To understand this massive push for automation, we first have to look at the immediate crisis forcing the industry's hand, right? We're talking about time, and we're talking about trapped capital. So what exactly is going on with the calendar right now?
Well, if you look at the recent source data, you see this phenomenon that's being called the settlement squeeze. Right now, nearly 50% of insurers are reporting that their premium settlement periods are actually exceeding 60 days.
Wow, 60 days.
Yeah, and just to put that in perspective, that is up from an average of 56 days just a year ago in 2025. So the timeline is extending. It's not shrinking at all.
Wait, a 2-month delay? I mean, we live in an era where I can send money across the globe from my phone in like 3 seconds.
Huh?
How is it taking a highly capitalized financial institution 2 full months to settle a premium?
Sounds counterintuitive, right?
Completely. And surely the massive legacy carriers have this figured out better than the smaller players, right? They have the resources.
You would intuitively think that. You'd think the biggest players have the most efficient, streamlined systems. But the data shows the complete opposite.
Really?
Yeah. The larger firms, specifically those processing more than 10 million transactions annually, they're facing the absolute longest timelines. They're averaging 59 days.
That is wild.
And the smaller firms are sitting at an average of 52 days. So, yeah, it's a huge issue.
So the bigger you get, the slower you get. I mean, that feels like a catastrophic structural flaw.
Yeah.
Especially because the transaction volume isn't just going to magically pause so these companies can, catch their breath.
Oh, far from it. Actually, the projections indicate the transaction volumes are going to grow by 29% over the next 2 years.
Okay, let's play this out. I mean, you already have a system that takes 2 months to process a payment, and now you're going to dump 29% more volume into that exact same funnel. It's like trying to sell a house, but having to wait 2 months for the check to clear while you still have to pay the mortgage. With a 29% volume increase coming, won't this system just snap?
That's the exact fear. But let's look at why a 60-day delay actually matters beyond just the logistical headache.
Yeah, play devil's advocate for a second. If the money eventually gets there, isn't it just like an accounting annoyance rather than a true crisis?
It matters deeply because of capital liquidity. In the insurance model, float is everything. You collect premiums up front, you hold them, you invest them, and you pay claims out of that pool later.
Right, that's the whole business model.
Exactly. So if a premium settlement takes 60 days to reconcile, that capital is essentially trapped in purgatory. The carrier cannot legally recognize that revenue.
Oh, wow. So they can't touch it.
Right, which means they cannot invest it, and they cannot use it as working capital. They are losing 60 days of investment income on millions and sometimes billions of dollars.
That makes total sense. It's a massive opportunity cost. But it's not just the carrier feeling the pain, right? This has to ripple out to their partners.
Oh, absolutely.
Yeah.
Let's look at the relationships with brokers and delegated authorities, like managing general agents or MGAs.
Right. The middlemen who underwrite and collect premiums on behalf of the carrier.
Exactly. Now imagine an MGA collects a premium from a client on day one, but because of this settlement squeeze, the carrier's payables and the MGA's receivables fall out of sync by 2 whole months.
So the books literally don't match for 60 days.
And that creates massive strain. The MGA needs to secure their commission, they need to balance their own ledgers, and the carrier is, demanding clarity on the risk they just took on. When timelines stretch this far, those crucial business relationships just degrade.
Trust completely breaks down.
Yeah. And on the flip side, the data clearly shows that Peer companies who move faster, the ones who actually shorten their cycles, they're releasing that capital earlier.
Right, so they have the liquidity to invest and grow.
Exactly. They offer much better terms to their broker networks. They become the preferred partner simply because they can do the math faster.
Okay, so we have this massive volume pressure, the timeline is extending, and it's causing severe capital liquidity issues. But I really want to understand the physical bottleneck here. Like, if I walk into the back office of one of these massive firms, what is actually causing a 60-day delay? Why is it so gridlocked?
The mechanism is a complete reliance on chaotic, manual processes and incredibly fragmented data. And we can put a very specific price tag on this operational drag. The sources indicate that a staggering 14% of operational budgets is spent merely correcting manual errors.
Wait, I have to stop you there. 14% of a massive operational budget is being burned just to fix typos and mismatched spreadsheet cells.
Yep, 14%.
How is that even possible? Why are these massive, sophisticated institutions still running their back office like a 1990s bake sale? Walk me through the life cycle of one of these errors. How does a typo cost millions of dollars?
Okay, let's trace a hypothetical but very common transaction. Let's say a broker sends over a detailed report of premiums, what the industry calls a bordereau.
Okay.
An analyst at the carrier receives this document, which is likely a massive unstandardized PDF or maybe a messy Excel file. They manually key that data into the carrier's core system, and they misalign a decimal point.
Oh, no.
Yeah. A $100,000 commercial premium is entered as $10,000.
Just a simple keystroke error. It happens all the time.
Right. But it doesn't just fail to reconcile silently. That error flows downstream. It hits the finance department where the ledger suddenly doesn't balance.
Right.
Then it hits the reinsurance team who miscalculate their treaties based on the wrong premium amount. A month later, during an internal audit, the mismatch is finally flagged.
And then all hell breaks loose.
Exactly. Now, a specialized team has to launch a full investigation. They have to trace that error back through 3 different software systems, dig up the original broker email, call the broker to verify, manually correct the ledger, and rerun the financial reports.
It sounds exhausting.
It is. That single decimal point just consumed 20 hours of highly paid human labor across 4 different departments. Multiply that by millions of transactions, and you arrive at that 14% budget drain.
It's essentially an archaeological dig just to figure out what someone typed on a Tuesday a month ago. And that 14% is capital being pulled directly away from growth initiatives, right?
Precisely. Instead of funding new product lines, they're paying a small army of analysts to play detective.
That is wild.
And this manual vulnerability is heavily compounded by data fragmentation. The report notes that insurers manage an average of 17 different data sources tied specifically to premium processing.
17.
Yeah, and roughly 66% of firms are juggling more than 10 sources.
17 different data sources just to figure out who paid what. I mean, it's like trying to translate a novel where every single chapter is written in a different language, and you only have a dictionary for 3 of them. Why are there so many sources?
A lot of it is driven by organic sprawl over the years, but the biggest culprit by far is mergers and acquisitions.
Ah, of course. M&A.
Right. When Company A buys Company B, Company A might be using 10 legacy systems. Company B brings along their 7 systems.
Right, they don't just magically fuse together.
Exactly. The C-suite announces the merger and talks about strategic synergy to the press, but down in the back office, an analyst is literally copying and pasting data from Company B's archaic green screen terminal into Company A's web portal.
You're cute.
No, it's real. The sources highlight that 54% of respondents cite mismatched systems and data structures as the #1 barrier during post-merger integrations.
So they never actually integrate the tech. They just build a human bridge of data entry clerks between the 2 systems.
Which leads directly to what industry experts call the spreadsheet ceiling.
The spreadsheet ceiling. I like that term. What does it mean?
Well, when cash management, bordereau handling, and premium flows are fragmented across 17 sources, companies default to the lowest common denominator to tie it all together, which is the spreadsheet.
Right. Good old Excel.
But relying on spreadsheets introduces massive manual risk at scale. The model completely breaks under the weight of everyday insurance realities.
What do you mean by everyday realities, like cancellations or adjustments to a policy?
Exactly. Say a client pays 80% of a premium because they are actively disputing a specific fee. A static spreadsheet doesn't automatically know how to apportion a partial payment across the underlying risks.
Right, it's just a dumb grid of numbers.
Exactly. A human analyst has to manually calculate that apportionment, adjust the ledger, and leave a note. This leaves finance teams highly exposed to audit risks, regulatory fines, and massive reporting errors.
Okay, so the diagnosis is super clear here. Spreadsheets and manual reconciliation are just crushing the industry. But artificial intelligence is supposed to be the white knight here, right? I mean, if you open any business magazine, it sounds like AI is already running the entire world.
That's the narrative, yes.
But looking at the sources, there seems to be a massive disconnect between what the industry wants AI to do and what is actually happening on the ground.
The gap between ambition and execution is vast right now.
Mm.
If we look at the theoretical role of AI, it is the perfect solution for this exact problem.
How so?
Well, AI agents, specifically using natural language processing and machine learning, they can ingest unstructured data from those 17 different sources. They can read a messy PDF bordereau, instantly understand that PREM, PRM, and premium_1 all mean the exact same thing, map it to a central data model, and automate the reconciliation instantly.
So it does the translation work without the human archaeological dig we talked about earlier.
Yes, it dramatically lowers costs, it speeds up the first step in claims, it completely eliminates that 14% manual error drain, and it fundamentally changes the speed of finance. And the early adopters who have successfully deployed this are already proving it. They're changing their entire cost structures and controls.
That sounds incredible. But the data shows those early adopters are a tiny, tiny minority, right? I mean, 82% of insurers expect AI to dominate the future. They see the writing on the wall. Yet only 14% have fully integrated AI into their financial operations. 14%.
And that leaves the vast majority stranded.
Right.
According to the research, about 80% of firms are stuck in what we call the partial or pilot stage.
Pilot purgatory.
Exactly. They are experiencing very limited efficiency gains, mostly because they are testing AI in isolated silos, while the core engine of the company remains completely manual. Oh, and 6% of the market uses absolutely zero AI, relying entirely on human workflows.
Wow. But hold on, let me push back here. If 80% of the industry is stuck in pilot purgatory, is it possible the technology just isn't as good as the tech companies claim it is? I mean, are they trying to run a state-of-the-art AI program on a mainframe from 1985 and it's just crashing? Or is this a human failure?
It is largely an internal expertise limitation. The technology itself works beautifully when deployed correctly, but translating complex, bespoke reconciliation rules into algorithmic logic requires a highly specialized skill set.
Right, it's not just plug and play.
Not at all. Legacy carriers have brilliant insurance minds, and they have brilliant finance minds, but they rarely have deep internal engineering teams capable of building and training enterprise-grade AI models to navigate 17 disparate, messy data pipelines.
So basically, 80% of the industry bought a cutting-edge sports car, but they're just sitting in the driveway listening to the radio because they don't have the internal expertise to put it in drive.
That is the perfect way to visualize it. You cannot feed an AI algorithm 17 flavors of unstandardized, dirty data and expect a clean financial report to pop out the other side.
Right, garbage in, garbage out.
Exactly. The transition from an isolated pilot test in an innovation lab to actual full-scale production in the core finance workflows stalls out because the foundation just isn't ready.
Okay, we've diagnosed the gridlock. We explain why the 60-day delay traps capital. We've traced the 14% budget drain to decimal typos, and we've explored why AI is currently stuck in the mud. For the operations directors and COOs listening right now, they need a way out. Based on the sources, what does the playbook for actual execution look like? How do you map the transition from manual spreadsheet chaos to full automation?
The transition has to be highly strategic, and it starts with step one, a relentless focus on the calendar. Leaders must prioritize reducing settlement timelines immediately to stop margin pressure and release that trapped capital.
So you don't just try to automate everything everywhere all at once.
No, definitely not. You look at the specific workflows causing the 60-day delays. If bordereau processing from your 3 biggest NGAs is taking 4 weeks, that is your very first automation target. You triage the biggest bleed.
Triage the calendar, I like that. But based on what we just discussed about the AI failing on dirty data, you can't just throw software at that bordereau problem, right? You have to fix the plumbing first.
Which brings us to step 2, simplifying the foundation. Before AI can work at scale, leaders have to reduce data fragmentation. You must untangle and simplify the mismatched data structures across those 17 average sources.
That sounds like a huge undertaking.
It is. But the mandate for a COO is to build or implement a unified data layer. AI algorithms need clean, structured data pipelines to reconcile payments accurately. If you don't standardize the data, you aren't fixing the problem, you are just automating a broken process.
Which means you'll just make the same catastrophic mistakes, only much faster. Okay, so step 1, you target the 60-day bottleneck. Step 2, you clean and standardize the data feeding into that bottleneck. What is step 3? How do you actually get the AI out of pilot purgatory and into the real workflows if they lack that internal engineering expertise?
Step 3 is moving from pilot to production by acknowledging your limitations and partnering smartly. The data suggests that firms must overcome this internal expertise gap by collaborating with specialized insurtech providers.
So outsourcing the heavy technical lifting.
Right. Instead of trying to hire a massive internal team of AI researchers to reinvent the wheel, legacy firms should leverage external platforms that are already purpose-built for insurance reconciliation. This allows them to deeply integrate the technology into the core finance operational bloodstream rather than running perpetual science experiments in siloed innovation labs.
It sounds like a total operational rewiring. But there's a cultural component to this transition too, isn't there? Because if the C-suite doesn't buy into this, the COO is never going to get the budget to fix the plumbing in the first place.
You're exactly right, which is step 4, shifting the strategic mindset at the very top. For the last decade, competitive advantage was largely viewed through the lens of customer acquisition. Firms poured hundreds of millions of dollars into flashy front-end features, sleek customer portals, beautiful mobile apps, chatbots that can quote a policy in seconds.
Right, the stuff the customer actually sees.
But the underlying mechanics of this current crisis prove that the true competitive battleground has shifted.
Right, because it doesn't actually matter how fast you can quote a policy if you can't reconcile the cash on the back end.
Exactly. The mindset must shift to recognize that back-office speed, accuracy, and capital liquidity are the ultimate differentiators now. The goal is to fundamentally rethink the stages of the settlement cycle. By letting an integrated AI layer handle the ingestion of unstructured data, the matching of premiums to policies, and the flagging of exceptions, you aren't replacing human analysts. You are elevating them.
They get to do actual analytical work instead of data entry?
Exactly. Humans are freed up to focus entirely on complex anomalies and relationship management. That is the exact mechanism of how you drive a 60-day settlement cycle down to 30 days, or even approach real-time settlement.
And crucially, that is how you stop burning 14% of your budget on an archaeological dig to find a decimal typo. So for an operations director listening right now, the mandate is incredibly clear. You can't just buy an AI tool so your CEO can mention it in a press release. You have to untangle your data foundation, partner for the technical heavy lifting, and focus relentlessly on driving down that calendar delay.
To synthesize the intelligence across all our sources here, the pressure on the system is only going to intensify. That 29% growth in transaction volume is a reality. At the same time, margins remain incredibly tight. We are actively witnessing a market where the operational divide is widening fast.
The winners and the losers are separating.
Very quickly. On one side, you have the 14% of early AI adopters who are locking in lower-cost structures, gaining massive capital liquidity by settling faster, and strengthening their relationships with brokers. On the other side, you have the manual holdouts, trapped by the spreadsheet ceiling, bleeding their operational budgets on error correction, and facing mounting audit risks.
It is a stark divide, and the runway to choose which side you want to be on is getting very, very short. And for you listening, it's worth taking a hard, honest look at your own daily workflows. Think about your department. Where is spreadsheet reliance quietly eating up your own team's budget and their time? How many human hours are spent just making sure column A matches column B across 10 different legacy systems? Because that time represents trapped capital. It represents lost opportunity.
It's an operational drag that has evolved from a nuisance into a true systemic threat.
Which leaves us with one final thought to mull over. We've talked deeply about the shift in where the real value lies within a company. We see that competitive advantage is shifting entirely to back office speed and accuracy. So what happens to the massive carriers who are still spending all their venture capital and IT budgets on flashy front-end customer apps? Will a modern policyholder or a broker even care about a sleek, beautiful mobile interface if the financial gears grinding behind it are backed up on a 60-day delay? If the engine is broken, does the paint job even matter?